Welcome to Industry Focus, the show that dives into a different sector of the stock market every single day. Today is Wednesday, June the 26th, and we're talking healthcare. I'm your host, Shannon Jones, and I have a very, very special guest joining me here today, none other than Jason Moser, live and in the flesh, fellow Industry Focus financials.
Sure.
Host,
but I mean, one could argue
healthcare-
that the two are very interrelated.
It's all-
right?
it's all the same.
You need good financials that'll keep you healthy, and then, bad healthcare will ruin your financials. So,
And that's a great segue because I've got Jason here today to talk about his healthcare and wealthcare basket. So yes, it's all interconnected, all related. Jason, always thrilled to chat with you. I'm really excited to get into the healthcare and wealthcare basket, but I think before we do, it's probably good to dive into the news that I think I've seen at least 20 to 30 different headlines just today about this one merger.
One deal.
We've gotten so many emails on Twitter. People are hitting me up. What do you think about it? It's all about this AbbVie Allergan deal.
Yep.
Let's just kind of run through really quickly here what that deal is all about, and then we can dive into our thoughts and opinions.
Sure.
So on Monday, AbbVie announced it would be acquiring Allergan, maker of Botox, in a cash and stock transaction worth about $63 billion. Each Allergan share would receive 0.866 AbbVie shares and $120 in cash, roughly. That works out to about $188 a share, about a 45% premium on the prior day's closing. So a pretty hefty premium. This is the second largest deal of the year. A lot of the industry-focused healthcare listeners will know we talked a lot about the Celgene Bristol deal that kicked off this year, I think at about $74 billion. AbbVie, though, trading down about 14% on the news, Allergan up about 25%. Not uncommon to see the acquirer get beat up, but they are getting slammed. I think
it does seem like that disparity is a little bit bigger than normal.
Yes, and we're gonna dive into all of that and more. But I think one thing, Jason, just here at Full HQ, there is not literally one person I've met so far that has said, wow, this is a great deal. I can't believe they waited so long to do this.
It feels like we're all kind of like, yeah, I get it. I mean, it's one solution to what seemed like was a problem that wasn't really going away. I mean, it sounded like there was a lot of noise being made for Allergan to split up in some capacity to maybe realize some value for shareholders that way. So this is kind of the opposite of splitting up, is joining forces with another company. It does seem like at least the two joining together, they're somewhat complementary. I mean, I don't know, there's a heck of a lot of overlap there in a space where scale obviously matters, particularly when you're facing problems like Allergan certainly is facing in a lot of key drugs coming off patent, some drugs that they were hoping for a bit more success that aren't really panning out, and slowing growth really across all lines. So it's understandable. I'm not sure that I necessarily think it's the best thing in the world, though. It's a big deal, like you said.
It's a huge deal. It's $63 billion. You've got basically two mediocre companies that have been looking for growth literally anywhere, now joining forces to become, I think, one just humdrum mediocre company.
Yeah.
Still looking for growth.
Mediocre is the perfect word, I think.
Let's talk a little bit about AbbVie. So, I mean, you kind of mentioned this. They have been desperately in need of diversification. Their bread and butter drug is Humira, made about $20 billion last year, about 60% of sales, so a huge chunk of their revenue. But it's facing a huge patent cliff. Actually went off its core patent, I believe, in 2016. But it's that patent exclusivity, particularly here in the U.S., that is on tap for 2023. AbbVie and their legal team, which I have to commend them, is probably one of the most creative legal teams out there, aside from Allergan. But they have really been trying to stem the tide. They've, I think, done over 100 different add-on patents to really kind of push away a lot of the competition. Hasn't really worked. We've already seen biosimilars in Europe starting to drive down sales. So Humira, during the first quarter of the year, global sales fell about 23% already ahead of this 2023 timeframe. So AbbVie here is desperately trying to throw the kitchen sink at the problem. but there just hasn't been anything meaningfully accretive to their top line.
Yeah.
It's particularly when it comes to their pipeline. They've got an approved drug, several in the pipeline. You're looking at maybe about $9.5 billion in annual sales just coming from expected drugs. That's not nearly enough to take care of that $20 billion Humira problem, though.
No. And I mean, you look on the other side of the coin there with Allergan. I mean, they're facing a lot of the same problems there. And, I was digging into their 10K yesterday just to get a better idea of how reliant they are on Botox, because I think that's the name probably most people associate with Allergan. And Botox is interesting in that most people probably think of it as sort of a it's that injection to help cure wrinkles and whatnot. It's somewhat, I don't want to say superficial, but I think it's kind of silly personally. I mean, we all get older, just accept it and embrace it. But some people don't. So Botox Cosmetics helps that. There is a Botox therapeutic side of the business, which I think is something we always need to mention because there are migraine implications there where Botox does help. So it's not a drug that is purely cosmetic. But either way, when you combine the two together, you're talking about $2.5 billion plus dollars in sales that Botox is responsible for Allergan. And that growth rate is slowing down a lot as well. So between Botox slowing down, the patent cliff that you were talking about there, I mean, it kind of goes back to that thing you said where you've got two sort of mediocre companies coming together. I don't know that necessarily makes for one great company. Maybe it makes for a big mediocre company, but is that something we want to invest in?
Not necessarily, Jason. Not for me personally. I know we actually got a question about this, like what should I be doing with this as an AbbVie shareholder and even some from Allergan shareholders. I think from an Allergan perspective, you talked about Botox. This is a drug. It's their bread and butter, as you mentioned, but they're already facing generic competition. The FDA approved a cheaper version of Botox. We actually did a show on it, I think, in February about the wrinkle wars that are now starting with a company called Evolus. So you've got your bread and butter drug under pressure. Their number 2 drug, Restasis, which is for eye disease, also facing generic competition coming in 2024. And of course, just like AbbVie, they've been trying to throw the kitchen sink at this problem. Allergan was the company, I don't know if you remember this, but this was the company that to try to protect their patents, they actually attempted to sell it to a Native American tribe.
I don't remember that.
For patent immunity. I mean, one of the most bizarre legal cases I think I've ever heard.
That
and even
creative.
just from a strategy perspective, really strange. So I think there was a lot of doubt cast on Brent Saunders with Allergan after that. So this is a company very much under pressure. So you've got two companies trying to hold things together. Also, Allergan has a massive amount of debt to the tune of about $21 billion. If this deal goes through, it would make for a combined balance sheet, net debt of $18.5 billion, plus another $40 billion added just to get this deal closed.
Yeah. And I mean, this is a market where debt loads are usually pretty heavy because these companies have to invest so much money in developing these drugs. And typically you need to develop a lot. So you have a pipeline that can shore up any weakness or headwinds when you run into situations. And so they tend to feed on a lot of debt, which is fine to a degree. Typically, they have the income statements that can help facilitate and cover that debt, but it's always something worth noting, particularly if you see two companies like this that are really running into some headwinds growth-wise.
Yeah, and I think with Allergan here, what AbbVie is trying to do with this acquisition, it's really not about growth. It's very much more about we need to fund R&D and we need to pay down some debt. And so you've got these cash cows like Botox that I think can help them do that. Mm-hmm. But this is definitely not a growth story. So if you're a growth investor, don't expect to see any sort of growth or innovation. Allergan is not one that really invests heavily in R&D in and of itself. This is really about debt, and it's also about funding continual R&D. So it still leaves the question, Jason, where is growth going to come from with this combined company? And I think that's still the bigger question and why you saw AbbVie take such a hard hit right after this news was announced too.
Would you say, I feel like maybe this is sort of a defensive acquisition. Would you think that's a good way to put it?
Fair.
I mean, on AbbVie's part?
I think that's fair. It's a very expensive defensive acquisition at $63 billion. I mean, that's that's a 4 times multiple on 2018 revenue right now, which is not unheard of in the biopharma space. But I do think that those multiples tend to go with growth opportunities, not so much from a defensive play. So I can see why they did it. But I would have loved to see AbbVie actually go after maybe smaller incremental deals that could actually drive growth long term rather than one huge, massive $63 billion deal. Didn't really address the issues that a lot of the investors have been poking and prodding AbbVie for. So you still have a lot of lingering question marks. If this deal closes, I think it's expected to close in early 2020. We'll have to wait and see what that looks like. But ultimately, to your point, this is really just a defensive play. And if you're an investor, a shareholder in either of these companies, as long as you're comfortable with that and recognize this is not necessarily about growth, I think you're okay.
Yeah, I feel like you raised a really good point there, and I feel like if I were going to be on that call and I could ask management one question, AbbVie management one question, it would be along the lines of what you were just talking about there. Instead of making this one mammoth acquisition, why wouldn't you go out there and try to find a bunch of smaller pipelines with some more attractive prospects? Because to your point, that is a ton of money they're spending on basically one business with some questionable prospects. I've got to believe there are a lot of smaller little biotech opportunities out there with some pipelines, kind of the way we talk about investing in this space anyway, right? Taking that basket approach, invest in a bunch of small biotechs, because some of them won't pan out, but some of them will. Why wouldn't they take that same approach? Because clearly they have the money to do it. But I guess we'll never know.
We'll never know. We'll never know.
We'll have to get on their next quarterly call and ask them that very question, Shannon.
I'll hold you to it, Jason.
Okay.
All right. So we'll be sure to keep all of our listeners up to date on all the latest happening with this deal as it pans out. So, Jason, before we dive into the stocks in your healthcare and wealthcare basket, maybe let's just set the stage a little bit for our listeners who may not be aware. What led you to this basket approach, and specifically this basket approach within the healthcare and wealthcare space?
Yeah, I mean, probably some folks are familiar with the War on Cash basket that I did. That was something that sort of came to be with Chris Hill and I just lobbing back the question every quarter on Market Foolery as to why we hadn't bought stocks in some of those companies, because clearly it was just a huge market opportunity. And what I thought of was, it is a big market opportunity, and it's not like you have to pick one winner. And so that was sort of the impetus behind this basket as well. Because, when you look at healthcare, as you know, and our listeners know, it is a massive, massive market opportunity, not only on a domestic level, but a global level. And just to put that into context, when you look at total national health expenditures as a percent of GDP here just in the country, you're talking about a number that's closing in on 20%. It is a big part of our overall economy, and that number is only continuing to go up. I don't think it's reasonable to assume that our neighbors here across the river are going to crack the code of healthcare anytime soon. It's going to be just an expensive market that's going to keep on growing. And so I thought, well, I like big and growing market opportunities, and there's not one company that's going to win this space. There are a lot of them. And so I just sort of took a stab at trying to find some of the companies in the space that I felt like could do well in the coming 5-10 years.
Great. So basket approach. And I think it makes a lot of sense, Jason. We recently put out, I believe it was an Instagram question about, do you invest in healthcare stocks? And I'd say the number one theme for those that said they did not was because they felt it was too risky. And for a lot of them, they were talking about biotech and pharma, which is exactly right. Very risky, very aggressive strategy. But I like the basket approach, in particular, the stocks that you have in this basket, because really, each of these stocks, and we'll get to them in a second, really serves a very critical need within the healthcare system.
Yeah.
They have opportunities, given all the reasons you just said, when it comes to pricing, when it comes to efficiency. This is just a simpler, less risky way to invest for those who are wanting some healthcare exposure, but don't necessarily want to go the biotech pharma route either.
Yeah, I do appreciate that. Like, the biotech space is really risky, and people probably associate that most with investing in healthcare, because those are probably the companies that get most of the headlines. And a lot of that's just because of that sexy growth everybody's looking for,
yeah.
right? I mean, it's that growth, and everybody's looking for a way to get rich quick. This certainly is not meant to do that. It is something where I felt like I could put together 4 companies that gave us a nice sort of risk profile that I think investors are looking to pursue. This is not a basket where these are all high-risk names. It is certainly not the only way to do this. This is just one way to do it. It is a way I did it. You can tell me I'm wrong, and I won't be offended. You can give me some other names that should be in the basket, and I will likely agree with you. But you got to draw the line somewhere. And so I just drew it at 4 companies. But typically, I look anywhere from 4 to 6 companies to go in one of these baskets. And these are companies that I've covered for a long time. And to your point, I think they all fire in on their own specific part of the healthcare system where they're going to continue, I think, to grow for the foreseeable future.
Yeah. So let's start with the first one. This is insurance company UnitedHealth Group. That's ticker symbol UNH. Jason, tell us about this one. Why does this one, why did it come across your screen, your radar? What makes it so interesting to you?
Yeah. I mean, we all like having access to healthcare, right? However we get it. I mean, we want to have access to it. It's a bit nebulous at times as to how we exactly do have access to it. I mean, you have a job, you get health insurance. It's not really clear exactly who that's with or what you get, or how much you're going to owe when you go to the doctor, because it doesn't seem like there's any real standard pricing model anywhere at this point. But the bottom line is that the healthcare system for the foreseeable future is not going to work without insurance. And UnitedHealth is the largest insurance company in the space, domestically and globally speaking. I mean, it is certainly spreading its wings. So, you look at a company in a market where, I mean, the service they provide is going to be essentially necessary for the foreseeable future. The size of the company matters, I think, in this case. And there are huge barriers to entry when it comes to health insurance. I mean, it's not like you and I could just go start a health insurance company. I mean, we could, but we would probably fail because there's a lot to do in just getting that business started. They've already done a lot of that hard work, and the size of the company tells you that they've been doing a pretty good job at it. So with vast financial resources, they're very well positioned to deal with any and all changes that come to the regulatory landscape in the coming years. It's a big company. It's a little bit lower on the risk profile, but that was kind of the point, was to give us a sort of a bedrock company where we know it's not going to be growing terribly quickly, but it probably shouldn't have the rug pulled out from under it either.
Yeah, I love this pick, Jason. It's really about the scale and the size of this company. You mentioned it's the largest insurer in the business. Also, single largest employer of physicians, more than 35,000 physicians. Largest in terms of the pharmacy benefit managers. They processed over $160 billion in payments. It's the size and the scale that I think is really important when we talk about cost efficiency with healthcare.
Yeah.
When you have that type of size, and also this is a company that's really been focused on data and analytics, more so than many of the others. I think that plus size and scale, if I had to put my pick on one company that I think could help drive down cost, it would be UnitedHealth Group.
Yeah, and I'm glad you said that, because I think a lot of people immediately will think UnitedHealthcare, largest insurer, healthcare for profit. This is just an evil company. And I mean, I understand that perspective, but I would encourage you to look at it from the other angle. I mean, it's not like UnitedHealthcare is the company that set up our healthcare system in this country, right? I mean, that's something that's been in the works for many, many years. In essentially, our politicians have kind of given us what we've got. There are all sorts of different philosophies and takes on healthcare. I would encourage you to go read a book called The Healing of America. I think that's what it's called, The Healing of America by T.R. Reid. It is a great book which talks about, he basically travels the globe and looks at healthcare systems in all different countries and compares them to ours to show where they're doing better, where we're doing better. So the number one takeaway from the book is this is not an easy problem to solve anywhere. And if you think that other countries have it all figured out, well, read that book. You'll see it's not quite so cut and dry. But yeah, I do agree with you. I think with a company this size, with its resources, I mean, they are going to be able to play a role in helping drive down the cost of healthcare. I think it's also reasonable to say, well, this is a company that has to answer to shareholders, which means they need to maximize profitability. So there is a bit of a delicate dance there for sure.
Oh, for sure. And I think, as we come up to the 2020 presidential election, we've heard a lot of rhetoric, Medicare for all. Yeah. We'll have to see how that plays out. But I mean, this is a company that was able to navigate the Affordable Care Act waters very well.
Sure.
So I have no doubt about them being able to navigate anything that comes down the road, should it happen.
I tend to agree.
Let's talk about the second one. So second company, medical device company, and this is Masimo Corporation. That's ticker symbol MASI. Jason, tell us what exactly they do and why this one is compelling too.
Yeah, this is one probably not as many are familiar with, but back in 2011 we had a thing that we did here on Fool.com where some of us who decided we wanted to try to run a real money portfolio in a public facing manner, we were able to do that. And it was this initiative called Rising Stars. And Masimo was a company that I found for that portfolio and bought in that portfolio back in 2011. And it struck me in researching the company, what they do. And I'll translate this, but they're in the business ultimately of pulse oximetry. And so whenever you go to the hospital, if you have to check in for surgery or anything like that, typically you're going to have something in there, a device, some equipment that measures the oxygen levels in your blood, among other things. And it's essentially required. Like you have to have that in there. Doctors need that in order to assess how you're doing. And so Masimo is in the business of that. They make those devices, they make the equipment and the consumables that help all of that happen. It's an interesting company from the perspective that the founder, Joe Kiani, founded the company essentially in his garage, figured out how to kind of build this technology, and then really just ran off with it. And nobody has really been able to develop something better. And now the company's celebrating its 30th anniversary. They've gone beyond pulse oximetry into other testing equipment and monitoring equipment. They have a beautiful razor and blade model. They get that big equipment in the hospital, and then the hospital has to keep buying those consumables, and it gives the company this opportunity to continue to innovate. The numbers tell us that hospitals like the technology. I like the founder-led culture. So it's a little bit of a higher risk play than UnitedHealth, but still a fairly well-established company. I own shares in it personally too. So one that I think will continue to do well.
Yeah, and they've actually got an augmented reality play.
They do,
as well, which is really interesting to me, especially as we talk about just the delivery of healthcare, staying connected, being able to make decisions faster. Tell us about this AR.
I think that's the cool thing about companies like these. They're small founder-led companies where they're not beholden to all of this red tape and trying to figure out what they want to do. They're essentially going with one guy's vision and the things that he wants to do. And he has assembled a team of innovators with him, and they all try all these different things. And a lot of it really, when you talk about augmented reality and virtual reality and how technology is going to help our healthcare system, eyewear, I think, is really the big medium for augmented reality technology in the coming years. You have Google and Microsoft and other companies that are working on those types of things. And so incorporating monitoring equipment or monitoring platforms for physicians, for example. So when they're in the hospital, regardless of where they are in the hospital, they can see a patient's progress or vitals right then and there, is a good example of what Masimo is doing to incorporate more technology into their business. And it's something where, with this company in particular, still very early days in how they're incorporating that. But reading about the things that they're trying, it's a pretty cool business. And again, I think it really all boils back down to the founder and his CEO. And the nice thing is he's a young guy too, so we should have a lot of years left to watch him kind of do his thing.
He's got a long runway.
Yeah.
All right. I love the play there, especially with innovation. And of course, we can't talk about redefining healthcare without talking about the third stock in your basket, and that is Teladoc. That is ticker symbol TDOC. I know we've talked about Teladoc on the show. Jason, tell our listeners, what did they do for those who may not be aware?
Yeah. Well, ultimately, it's virtual healthcare, right? It's seeing the doctor over the internet. And this is a really neat business that I started following this business shortly before it went public. And I had spoken with a friend of mine at the Dallas Business Journal at the time, and we were talking about the company going public and what its chances were. And even back then, I thought, what, they're solving a problem that exists. And I, it made me think back to the day where, David Gardner was talking about, like, with Amazon, and how there was so much skepticism back then that people would ever even consider putting their credit card information on a website and buy something from a website. There's just no way. There's no security. That's balderdash.
Sorcery.
Fast forward to today, and we obviously know that result there. Anybody in the world pretty much knows that going to the doctor's office is not a pleasant experience. And it's not always necessary either. And I think that's what this company was really geared on from the beginning, is trying to become sort of that new front door for the medical care experience. There are situations where you don't necessarily need to go to the doctor's office. And Teladoc has built a nice virtual healthcare app that enables people to go ahead and use that app as essentially that first step in their healthcare pursuit. And I mean, I can use just a specific example that happened to me in my life, where I just immediately, I thought, you know what, I'm sold. This is for real. I was taking my daughter, I'm sure some people have heard this story before. I was taking my daughter to a horseback riding lesson. I saw that my eye was turning red. You have kids, then you know what pink eye is. And I thought, oh God, now I've got pink eye. And then you know how you got to go to the doctor, you got to get the prescription for the drops, and it's a waste of a day. So I park in the parking lot. My daughter goes in and starts riding. I open my phone, open the Teladoc app. 20 minutes later, after having a video chat with the doctor in Texas, of all places, and we're in Virginia, she was able to diagnose the pink eye, prescribed the eye drops to the CVS by her house. I picked them up on the way home. Problem solved. $15 copay. Easy peasy, lemon squeezy, as they say. And that's ultimately what they're doing. They're not trying to say, well, if you have a heart attack, you can use Teladoc. That's not what you do. But there are cases where it does work. And so I think what we're seeing now is buy-in in the virtual healthcare space. All of the regulatory barriers have all been cleared. I mean, the regulatory environment has been changed to accept virtual healthcare, and UnitedHealthcare is another business that is helping shape that. And believe it or not, Teladoc is actually a partner of Optum with UnitedHealthcare, so big base there as well.
Yeah, and just a huge growth opportunity. 85% of the U.S. will contact a health professional in any given year. That translates to about 1 billion office visits annually. Teladoc has the potential to actually, right now, they're doing about 2 million of them. So when you look at that runway over the long term, huge opportunity. Mental health.
Yeah, that's another big one.
Huge area. I think with a lot of the stigma associated with mental health, and it's becoming just much more okay to talk about, and people are wanting assistance with mental health. That's a huge opportunity as well for Teladoc too.
It is, and you mentioned a good word there in the stigma related that's associated, I think, with mental health care. Finally, now we have a way where someone can pursue mental health care without necessarily having to even leave their home. And that really, I think, opens people up to the possibilities of even asking for help in the first place. Because if you feel like you need that help, and then there's the option for you to actually have a visit without ever having to leave your home, well, that's the ultimate form of privacy right there. And we're certainly seeing the company making big investments in that space as well. And it does seem like mental health is becoming a more talked about thing here, nationally speaking. I don't know. That's my perception.
I
it
totally
seems like it's
agree.
being talked more about, and that's good.
Totally agree. So I think for a company like this, it's all about access. But that brings us to the fourth stock in your basket, Jason, because access is not just for humans. It's also for our furry animal friends within our family. And that brings us to Idexx Laboratories, and that's ticker symbol IDXX. Jason, we are literally covering the entire gamut of healthcare. We've got animals now.
Well, yeah. And I mean, one of these things is not like the other. But listen, this is coming from the perspective of the owner of 3 dogs, okay? I've got 3 dogs at home. I grew up with a house full of dogs and my mom's cat. We've had animals and pets all of my life. I have a very, very soft spot in my heart for them. And I could never imagine a day without them. And so for me, finding Idexx Laboratories, I've been following this company for years, and part of the reason why I discovered them was because of my veterinarian. And this is another, we talked about Masimo being a razor and blade model. Idexx is a razor and blade model as well. They get that equipment into the labs of the veterinarians, and then the veterinarians use the consumables to run diagnostic tests. And typically with pets, they're fairly standard. You take them in for their annual checkup and they get their shots and whatnot. But what veterinarians are finding, particularly as pets get older, is that there's just simple little diagnostic tests they can run via either urine or fecal or blood to discover if there are issues that are coming up far earlier that you need to address. And so between that, the fact that the pet care market is such an attractive one because we feel so strongly about our pets, and it's typically a cash business. I mean, I know there's pet insurance, but most people don't use it, and I'm still not convinced that's actually a really credible market anyway. There are just a lot of things to like about what IDEXX is doing. It's a competitive space for sure. And one of their competitive advantages is that they continue to reinvest in their business and develop new tests and diagnostic equipment and things. So as they continue to reinvest, I mean, that would be a concern of mine, is if they started pulling on those purse strings a little bit, then I'd be a little bit concerned. But as it stands, they continue to invest heavily, bring new products. They've got a great reputation with veterinarians, particularly the private practices. So a lot to like there. It is really a play on what is, I think, a very attractive market in pets. Do you have any pets?
I don't. No. My husband is allergic to anything with fur.
Well,
we're working on him, though, because I grew up with dogs. So my heart is, I have a huge heart for animals in general. So does my daughter. So we'll get there. But yeah, I can see a company like this with such a massive focus on pet care in general.
Yeah.
I think that's an area that doesn't get enough focus right now.
Probably not.
The medicinal market for pets is huge.
Yeah.
CBD now for pets.
Yeah. I mean, I was talking yesterday on Market Foolery about Zoetis, which is the company that was spun out from Pfizer, and they're the ones that develop those vaccines and medicines for animals. And, whenever I go to the vet, I'm not lying to you, that bill, I see IDEXX and Zoetis on there. So you now understand why I own shares in both companies. Because I'm getting at least something back from that money I'm putting out there.
At least something you're getting back there, Jason. All right. So to close us out, Jason, tell us a little bit about performance. How has this basket done for you?
Well, the basket has done very well, I'm proud to say. This was the date of inception of this basket was February 9th of 2018. That's when I opened it up and introduced it to everybody. And thus far, an investment in this basket is up 55% versus the market's performance of 11.4%. So it's done very well. There are all four companies are absolute positive returners. Three of the four are beating the market. I will say the one that is underperforming the market, which is UnitedHealthcare, or UnitedHealth Group, is underperforming the market by just a 0.5 percentage point. So it's pretty close. But any which way you look at it, they're all four contributing to the performance there. And I think that's slated to continue.
Yeah, pretty stellar performance. Jason, I'm going to have you back on the show because we want updates on how this basket is performing. Think you'll rejoin me back on the show for an update?
You know that I'll be in here anytime you ask me.
I appreciate that, and I'm sure our viewers do as well. And that will do it for this week's Industry Focused Healthcare show. Thank you so much for tuning in. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. This show is being mixed by Austin Morgan. For Jason Moser, I'm Shannon Jones. Thanks for listening, and full on.